Have you ever bought a computer, a desk, or a vehicle for your home care agency and wondered, can I write this off? The answer is usually yes, but maybe not in the way you think. I'm an enrolled agent with over 14 years of experience helping business owners navigate taxes, accounting, and IRS rules. And today, let's talk about assets and depreciation because this is one of the most misunderstood areas of business taxes. In the last video, we talked about startup costs, and I mentioned that some purchases don't fall under the startup cost rules. Instead, they may be considered as business assets. So let's talk about what that means. First, what is an asset? An asset is generally something you purchase for your business that is expected to last more than 1 year. For a home care agency, that might include laptops, desktop computers, office furniture, filing cabinets, printers, vehicles, or equipment used in the business. These items help your business earn money for several years. And because of that, the tax rules often treat them differently than ordinary expenses. Think about it this way. If you pay your monthly internet bill, that service is consumed during the month. But if you buy a laptop, you may use it for 3, 5, or even 7 years. That's why the IRS says this isn't just an expense, it's an asset. For example, imagine you're opening a home care agency. You purchase 3 laptops for office staff, a scheduling computer, office furniture, a printer, and a vehicle used for agency visits. Those purchases may cost thousands of dollars and they may continue helping your business generate revenue for years. That's why the IRS often treats them as assets instead of ordinary expenses. Now, there are 2 broad categories of assets. The first is a fixed asset. These are physical things you can touch. Things like vehicles, computers, furniture, equipment, and office fixtures. The second is an intangible asset. These are assets you cannot touch. Examples might include certain purchased software, business goodwill, or other intangible rights acquired in a business purchase. When fixed assets are deducted over time, we call that depreciation. When intangible assets are deducted over time, we call that amortization. Different words, same basic idea. The cost is spread out over a period of time. Why? Because the IRS wants to match the cost of the asset with the years the asset helps your business operate. A laptop purchased today may help your agency for several years. A vehicle may be used for many years. So instead of deducting the cost of all that once, the tax rules may spread the deduction over time. That's the basic idea behind depreciation and amortization. Now, here's where many business owners start to worry. They hear the word depreciation and immediately think, great, now I need a complicated spreadsheet. The good news is not necessarily. Many smaller purchases can often be deducted immediately under special tax rules. And for many small business owners, tax software or a tax professional handles the depreciation calculation. So don't let terminology intimidate you. The important thing is understanding the difference between an expense and an asset. Now, here's the really good news. Many home care agency owners hear the word depreciation and assume they must wait years to receive their deduction. That's often not the case. The tax law includes special rules such as Section 179 and bonus depreciation. These rules often allow small businesses to deduct much or even all of the asset cost in the year the asset is placed into service. In plain English, you may buy a computer, office furniture, a printer, or certain equipment and still receive most or all of the deduction right away. The exact rules depends on the type of asset, how it's used, and your specific tax situation. But don't assume that because something is an asset, you won't receive the current year deduction. That's a very common misconception. And here is one more piece of good news. The IRS also has what's called a de minimis safe harbor election. That's a fancy way of saying that certain lower cost items may be deducted as an expense instead of treated as an asset. For many small businesses, that threshold is generally $2,500 per item or invoice. So if you purchase a computer, a printer, or other business items that falls within those rules, you may be able to expense it immediately rather than track depreciation. Now, there are requirements for using this rule, and it doesn't apply to every situation, but it's another reason many small business owners don't need to worry about complicated depreciation schedules for every purchase. The important thing is to keep good records, save the receipt, document the purchase date, document the business purpose, and keep a record of what was purchased. Because good records make tax preparation easier and support your deduction if questions ever arise. So what's the big takeaway? An expense is generally something your business consumes within the year. An asset is generally something your business uses for more than 1 year. And because assets provide value over multiple years, they often follow special tax rules such as depreciation or amortization. The good news is many small business owners can still receive significant deductions through provisions such as Section 179, bonus depreciation, and in some situations, the de minimis safe harbor election. The key is knowing the difference between an asset and an expense and keeping good records. Now, here's another area where I see a lot of confusion. Many business owners support causes they care about. They donate money, sponsor events, support local organizations, or give back to their communities. But does that automatically make those payments tax deductible? Not always. And the answer depends on several factors, including how your business is structured. That's exactly what we'll cover in the next video. I'll see you there.